Hey everyone, welcome back to Perspicium. Today we are diving deep into a quiet superpower used by hedge funds. Investing isn't about chasing returns, it's about keeping risk steady when markets get wild. Most people only think about returns, but the pros, they obsess over return per unit of risk. Look here at the S&P 500 during dot-com crash. These are daily returns. Notice all the sharp spikes up and down? That's volatility. Let's zoom out. The chart shows 30-day rolling volatility for S&P 500. See the column stretches around 10 to 12%, marked by dashed median line, and see the surges, like the massive spike in 2020 that shot above 80%. We also see waves in 2018, 2022, and again in early 2025. If you're just buy and hold, your risk moves with this line, low in quiet times, but suddenly massive during crisis. This is where volatility targeting comes in. The green dashed line marks a target of 10% volatility. When the realized volatility rises above that level, the notes say, too hot, scale exposure down. That means you reduce your position size. When volatility falls below 10%, the note says, too low, scale exposure up. That means you increase your position size. You're not letting the market decide your risk. You're deciding for yourself. Think of it like cruise control. The road can be smooth or stormy, but your speed, your risk stays steady. That steadier risk profile makes drawdowns more manageable and creates a cleaner stream of returns. So you might ask, why go through all this effort? Because volatility is the enemy of compounding. Look at these equity curves. The blue line is S&P 500, a simple buy and hold strategy since 2005. The orange line is the same S&P 500 but managed to stay around a steady 10% volatility. Notice what happens in big crashes, 2018 and 2020 especially. The buy and hold portfolio plunged deep, while the volatility targeted strategy automatically scales back exposure, cutting those drawdowns. Yes, buy and hold sometimes leaps ahead during long bull markets, but when the storm comes, volatility targeting avoids the worst damage. Here's another way to see it. These box plots show the distribution of yearly drawdowns. On the left, buy and hold, with some years dropping more than 50%. On the right, the volatility targeted strategy keeps most years' drawdowns far smaller, usually in the 10 to 15% range. That's the power of controlling risk. It doesn't eliminate losses, but it makes them far more manageable. And this leads to the real payoff, huge risk adjusted returns. Hedge funds measure this with something called Sharpe ratio, how much return you earn per unit of risk you take. On the left, buy and hold S&P 500 scores a Sharpe ratio of about 0.62. On the right, the volatility targeted strategy comes in higher at 0.76. That cleaner, more stable Sharpe ratio is exactly what professional investors want. It means a smoother ride, steadier compounding, and a portfolio that clients want to stick with in the long run. Let's make it really simple. Suppose your target is 10% volatility. Here's the rule of thumb. Exposure equals to target volatility divided by realized volatility. So if the market's realized volatility is 20%, then 10 divided by 20 is equal to 0.5. That means you cut your exposure in half. If volatility is exactly 10%, 10 divided by 10 is equal to 1. You stay neutral, holding your full position. If volatility is just 5%, 10 divided 5 is equal to 2. That means you double your exposure. Here's an example with Bitcoin. Watch the exposure bar. When volatility spikes, the bar drops, shrinking the position. When volatility calms, the bar rises, letting you take on more exposure. Think of it like a thermostat. When it's too hot, you cool things down. When it's too cold, you warm it up. It's not about predicting the market. It's about controlling how much risk you're taking at any moment. This isn't just theory. This is how some of the largest funds in the world make money. Take risk parity funds. Instead of putting 60% in stocks and 40% in bonds, they size positions so that each asset contributes equal risk, not equal dollars. Look at this pie chart. Equities, bonds, and gold each take up a slice, not based on how many dollars are invested, but on how much risk they each contribute to the portfolio. That's the difference institutions care about. Stocks are more volatile, so their slice is smaller. Bonds are steadier, so their slice is bigger. Here's another way to see it. On the left in blue, you've got traditional dollar weights, 60% stocks, 35% bonds, and 5% gold. On the right in orange, those same assets are scaled by volatility. Notice how equities shrink, bonds stay about the same, and gold's weight jumps much higher? This is what volatility scaling does. It rebalances the portfolio so that calmer assets pull their fair share of the load. And this is how it looks like through time. Each color here is the share of the total risk coming from stocks, bonds, or gold. Notice how without scaling, equities often dominate risk during crises. With scaling, those contributions are more balanced, even when markets get turbulent. Funds like Bridgewater's all-weather portfolio and firms like AQR build entire strategies around this concept. Even ETFs today use volatility targeting. Why? Because it works. It prevents sudden blow-ups, avoids overexposure, and keeps clients' capital safe while participating in growth. Now let's look about how can you use this across multiple asset classes. Here's the Sharpe ratio comparison for S&P 500, long-term treasuries, and Bitcoin. In every case, the orange bars, volatility targeted portfolios, score higher than blue buy and hold bars. This means better risk-adjusted return no matter what the asset class. Now look at the tails. The worst outcomes over 30-day periods. The dashed line represents buy and hold. And notice how the white tails stretch, especially for Bitcoin. The solid lines are volatility targeted, and those are much tighter. You're not eliminating risk, you're making it more predictable. And for institutions managing billions, predictability and smoother compounding matters far more than squeezing out every last bit of raw return. Now, here's the best part. You don't need to be a hedge fund to do this. You can do it yourself. All you need is realized volatility. Basically, how bumpy the returns have been over a rolling window. And that's exactly what we give you on Perspicium. Just go to perspicium.com, open the dashboard, click on the risk and beta section. Scroll down and you will see rolling volatility. You can pick window length, 20, 30, 60 days, whatever makes sense for your strategy. Once you know the realized volatility, the rule is simple. Set a target volatility you are comfortable with, then adjust the position size as target divided by realized volatility. If the volatility spikes, cut back. If volatility calms down, lean in. That's it. One adjustment, done consistently, and suddenly you're managing risk the same way billion-dollar hedge funds do. If this video helped you, don't forget to like and subscribe. It really supports the channel. And if you'd like to learn more about quant finance, check out the other videos on my channel. Thanks for watching, and I'll see you in the next one.